Well, it's very interesting. We step back, what is it, a couple months or so, and we look at, the Saudis coming in and buying almost 1 million shares of SLV, and that's a pittance relative to their liquid capital, but yet it's enough to, raise some eyebrows and ask the question, are sovereign nations coming in the silver market? And the answer is yes, in a very light way. But the more important part of that is they are big enough of a purchaser to be able to demand physical silver, which, if you think about it, could put some heat on the silver shorts because now you've got a nation state that owns part of the SLV and they say, hey, here's your shares back. I want to cash it in for real silver. So that's a bit of a, I'll call it a threat. At least it's a bit of something that would make them think about it. So now what you do is, well, you short the heck out of the stock, the SLV, and you get ready to move the commodity down. And how do you do that? Well, that's pretty simple. It's been done again and again and again. And that is you keep selling more silver on paper that doesn't exist until you get pressure to move the price down. But if that doesn't work or isn't working as well as it normally does, you raise the margin requirements. So now if you've got to put up 10%, you raise them up and you got to put up 15%. And if that doesn't work, you raise it again to where you got to put up 20% of them. And if that doesn't work, you raise it to you got to put up 30%. And if that doesn't work, you put it up to 40%. So you keep taking out the little guy, especially, and even some of the trading funds that say, I'm out because I can't put up that much cash or I don't want to. I'm going to take a profit here. So it adds to the selling pressure. So that's what I expect to see here shortly is that there's more uh, margin, requirement going in. And what could happen, and I want to emphasize the word could, not would, because we're getting into new territory. We're pushing toward 50. The market's acting stronger than many believed it could or would. And we're seeing pressures like you just mentioned, the SLV, the retail market outside of the United States, and something is definitely going on in the silver market. So moving on from there, what if we're in a situation where the demand for silver blocks physically supersedes or overrides the paper market? Where I don't care how much you short, give me the silver, put up or shut up. I need it and I need it now, and I'm paying a premium for it. Give it to me. We have a delay. And I'm not saying that's what's happening, but it's acting as if something like that is taking place. I don't want to be overly enthusiastic here. I want to try to remain objective and level headed. But the facts are, as you outlined them so eloquently, we got backwardation, we got retail purchases, we got people shorting the SLV shares and they can't short anymore. What happens when you sell, and it doesn't take the price down? Well, that's kind of what they're doing in the SLV. They're selling as much as they possibly can, and the price is going up. That's a head scratcher. It always worked before. Why isn't it working now? Yeah, that's a great question. I wish I had an absolute answer. I don't have a feeling, but if there's, I won't. I'm not trying to brag here. It's just a fact. I mean, there aren't too many people sitting in my position that have been around or in this market for decades, and I have. And you kind of get a sense of where the market is or where it's going. It feels as if it's a little ahead of itself. But Alan Hibbard and Mike Maloney did an update. They do several. They do maybe one a day. I don't know. I don't watch them all, but they did one on why it's different this time. And Alan showed how many days above 40 silver has traded in the past. I don't remember the exact numbers, but I think in the 80s it was like 7 times, and then in 2011 it was like 17 times. And if I remember correctly, this time it's at like 20 already. So that's what you want to see for a strong market. You want to see that 40 handle isn't a 1 day or 1 hour event like the $50 mark was in 1980. Yeah, it hit 50, but it was not there sustainable. But now we've sustained 40 longer than we ever have in the past. So the long answer is we are where we are. We may just blow through 50 and keep on going, which would be extremely detrimental to the shorts right now because they're betting with They're short in the SLV. What they're doing, the committed traders looks favorable to them, but not at an extreme. And they're doing whatever they can with this margin thing that they've only upped once. I wouldn't be surprised to see margins go up today to get control. If that were to go the other way, as I outlined, then there could be someone leaving the fold and saying, I'm going to buy back my short. I can't take the pain any longer. That is very, very rare, but it could happen. So if one of the four major bullion banks that historically have huge short positions decides to bail and say, I can't take it anymore, I'm going to buy it back. Well, that's buying pressure, not selling pressure. Take the price even. So the answer is, I don't know. My gut feel is that it's going to go a little higher, maybe hit that 50, 52, 53. I don't know. And then all of a sudden they win and they do enough with margin requirements to bring the market back down. I mean, I'm doing that based on probability. Every time you've seen a market do a runaway, like Palladium did in the early 2000s, they upped the margin requirements to got to be where you had to have cash only for a margin account. So in other words, if silver is a 5,000 ounce contract and it's at $50, what is that? 50 times 5,000, 250 grand. Is that right? Do the math right. Anyway, so instead of putting up 10% or putting up 25,000, you got to put up the full amount. You got to put up the full 250K. Well, that's a cash market. So they're forcing the futures market into a cash market. They did that in Palladium. And guess what? It wasn't enough. They actually got it above that. So I actually had 4 contracts on at Palladium when that took off. And I forget where I bought, but it's like, 200. I have to look. But it was 200, went to 300. And my broker called me and said, you got to put more margin. More margin? Are you kidding? I wanted to buy more. I was thinking, I'm forward a low base. I could add 1 or 2 very conservatively with all the extra cash in my account. I was, oh, no. It doesn't matter. You're winning. You already got all this extra cash in your futures account. The margin requirements are going up across the board, long or short. And I learned that one the hard way. That was, like I said, in the early 2000s. I've been trading futures for quite some time and didn't know that. But that's what can happen. So all I'm saying is caution is here, especially if you're on leverage. If it were me and I was holding any contracts, 110 or 100, I'd be lightening up or getting out for now, taking the cash profits, taking that cash and turning it into physical silver and standing by and wait for a while. Now, if it goes to 60, then having said that to you, I'll get a lot of hate mail. But, being in this game for a long time, it's always good to sell in the strength. Because once you start getting that point where the market does reverse, that's hard to sell. Now you're selling into a lot of sells, which begets more selling. So where are we going? I'll say it again. I'm not sure, but it certainly is acting like it wants to go higher from everything we've talked about from the initiation of our interview. Normally where they've been and what's always worked, I mean, it's called going to the well. I don't know if you know that expression, but you go to
Mhm.
do what always works so many times, and then you go back to the well and it doesn't work. And that's a shock. Now you don't know what to do. Wait a minute. This is my last resort. Always happens, always works. And it's not. Now you get a little bit panicked. And that's why you could get in a position where one of these bankers says, you know what, I'm getting out, man. We are eating it big time. We shorted at 42. We added more shorts at 44. We creamed it at 46, and now we're pushing through 50. I can't take the pain anymore. I'm not saying that will happen, but it could happen. Well, there's a term for it, and it's called backwardation. And what it means is exactly what you said. Backwardation means that there's the spot price, what I can pay for today to get the product, be it wheat, rice, soybean oil, or silver, is higher than something in the future. Now, just to belabor this slightly, Danny, because I don't know the level of all of our viewers, but the futures markets in all aspects go in what's called contango, which is the price today is lower than the price in the future. and the
Mhm.
future price is usually determined by the interest rate on the 10-year note, 10-year bond, for example. So if you've got a yield of, and this is a rule of thumb, but generally, if you're going to buy something in the future, it's going to cost you more than it costs today. If it costs more today, that backwardation means that I've got to have it. I am willing to pay up. I'm willing to pay beyond, a future price to have it today.
Wow.
So it means there's a strong immediate demand. Buyers urgently need the physical commodity, be it oil, metals, or grains, now, not later. It does indicate supply tightness. Inventories are low and it's hard to get delivery in the near term. And then there's fear that comes into it, fear of a shortage. Traders that on this end may worry about running out of supply. So maybe there's someone out there that didn't stockpile enough silver for their solar panel demand. And they got a delivery coming up and they're not going to get it. Implication for the precious metals is it suggests that buyers doubt whether they can get real metal later. And this happens. I'm not trying to make a case. Oh my goodness, it's happened several times in the past. It usually lasts a few days, and then the market goes back into contango, which is the normal, costs more in the future than it does today. However, persistent backwardation. So let's say it goes like a week straight. That would be very unusual, Danny. That would indicate a distrust in the paper contracts. They're not trusting the COMEX. They're not trusting the LBMA. They're not trusting their counterparty that has it stored in a brokerage account. I don't want my metal. I don't want it now. So, practical meaning for investors, for a futures trader, backwardation means that you can sometimes profit by rolling the contract, selling the expiring contract higher, and buying the next month cheaper. And that happens all the time. And that's why it usually goes back into tango. So basically, oh, wait a minute, my car could get me, 8,000 today, and I can buy it 2 months from now for 7,000. I'm in, baby. Hey, sell the car, man. I've already got it locked up for $1,000 profit. And that does take place. Yes, even in the silver market. However, having said all of that, Danny, and I'll finish here, is that what if you get a piece of paper that says I'll give you that car for 7,000, and then you go to collect? Oh, I'm sorry, I misquoted my inventory. I don't have that car. What happens then? So that's hopefully a good explanation of backwardation and what it means and what it could mean.